Let's bring in Steve Sosnick. He's the chief strategist at Interactive Brokers. Bet you didn't see that one coming. Total return versus price return.
I've been harping the dividend trade for months. I've been saying get involved in dividends because that helps your return. That's a big part of it. But again, as Mike noted, the dividend yields are lower because the prices are higher.
But I think the point is that, like, let's say you're in the S&P 500 and you're looking at and this is important for people who have active managers, because the active manager says, I'm outperforming on a price return basis, but you got to have the total return to see if they really are. So in other words, without even trying to adopt a dividend strategy, a lot of investors are doing much better than the index actually says this year on a price level basis alone.
Absolutely. Also remember, a lot of investors, a lot of the hottest stocks have been your best performing stocks. So, I mean, somebody who just basically put it all in NVIDIA at the start of the year is outperforming everybody. So it really depends so much on your stock selection and your balance. And I think that's kind of why, you can't always outguess these things. Yes, with 20/20 hindsight, I wish I'd put it all in NVIDIA myself, but I didn't.
Well, and the point is, we're always going to feel that way. There's always going to be something where you kick yourself and say, well, if only I was in that. So indexing in the long run, I saw a tweet the other day that made me laugh, and the guy said, why have I been wasting my time on UK small cap stock picking when I could have just, been in the S&P since 2000 and basically done nothing and done great?
FOMO is a very powerful motivator, and that's one of the things we're seeing now is nobody wants to miss this rally. That's why we see dip buying, at even the slightest dip now, the dip buyers come out, and we also see rally chasing. That's where the momentum is coming from. I'm not going to say it's all FOMO, but nobody wants to miss it. And quite frankly, if something's working for people, they're going to keep doing it, and it's been working. The question is, at some point, this inevitably stops working. When and what might be the signals to when it does stop working.
I noticed Dennis Gartman, for instance, said, I'm not shorting this market anymore. You just can't. So let's spin this forward now. Forget about hindsight. Forget about 2020. Yeah. I mean, what are the takeaways, the positioning strategies for what the next few months kind of into 2025 could bring?
I think it's hard to short this tape, but it's not necessarily wrong to start to take profits. Again, I think we probably don't see profit taking till the beginning of till the next calendar year because, number one, that's just normal tax strategy. Number two, I think people might be hopeful for some sort of improvement on capital gains rates. So you're not going to see a lot of that, which is probably one of the things that keeps the path of the momentum trade in place. I think what could unravel it is some sort of concern out of the rest of the world about what we're doing, or the bond market freaking out a little bit. It freaked out a little on Wednesday, then recovered since then.
Dan Clifton was on our air earlier this week making the case for it not freaking out from here. He mentioned the Treasury General account. Maybe you get some stimulus from that when you hit the debt ceiling in the first quarter, but also that the deficit could end up coming in by $300 billion or so, regardless of who takes office next year. The CBO doesn't have that in its baseline. Are there factors that maybe make people think the TLT trade, for instance, or shorting it or whatever is no longer such an obvious thing?
It's really hard to say because we don't know. Because remember, the tariff policy is one of the things that could spook the bond market in a big way, and tariffs don't need to be going through Congress.
I don't follow that, though. I don't follow why, if you increase the cost of one thing, inflation in the entire economy goes up. If the price of shoes from China doubles, then people who don't have more money are just going to take that spending from somewhere else, right? On net, that doesn't that doesn't increase the money supply.
It doesn't, but what happens is if the cost of shoes go up and you need the shoes and you have kids who need shoes, you're going to have to buy them. And what happens is the cost is going to go up, and that's money that you can't spend elsewhere. So it does have a negative effect either on economic growth, or consumer spending, or it has an effect just because the prices get raised, right? I think about like the washing machine tariffs and trying to buy a washing machine when those were going in place. The domestic production hadn't caught up yet. But Whirlpool and the domestic machines were able to raise their prices.
Right.
So in the short,
But I think that's why when you go back to the first Trump administration, by year 3 they were cutting rates, right? If we all say, well, what happened the last time when they slapped tariffs on the economy? We didn't see inflation, right? We didn't see an inflationary economy. We didn't see a Fed having to hike rates in response to that. We didn't see long end yields really going up.
I think also though that the one of the keys here is the globalization in terms of the tariffs then were tended to be a bit more targeted and a bit smaller than what we're hearing about now. That's what I'm saying. This is the problem is why momentum is sort of working, because there isn't necessarily anything to upset this. What we're talking about is all speculative. You could get some sort of freak out from foreigners not wanting to buy our debt, et cetera, et cetera. But what we're talking about is all hypotheticals, and that's kind of why people in trading mode are just sort of sticking to the here and now.
Absolutely.